earlier regarding public issues before. Does anybody recollect those? What are the different types of issue of securities and what are the different issues involved? Earlier we had discussed that issues could be of four types. First is public issue, second is rights issue, third is preferential issue, and fourth is bonus issue. Public issue is further divided into IPO and FPO. We can either issue equity shares or other securities. Equity shares and convertible securities, they have to follow this chapter, which is called ICDR regulations. Other securities and non-convertible securities, they follow ILDS regulations. So we are first learning ICDR here in this particular chapter. So IPO and FPO put together are public issues. Bonus issue has no consideration, but it is given to existing shareholders. Rights issue has consideration and is also given to existing shareholders. Private placement, preferential issue, and QIB issue, they are all considered to be similar because they are only given to selected shareholders. These selected shareholders can be either existing, they can be selected from existing shareholders, or they can be completely new shareholders. When none of these restrictions apply, then you call it a public issue. In a preferential issue and private placement, the main difference is the number of people that you're issuing the securities to. In a preferential issue is much higher. And in a qualified institutional placement, we only issue securities to QIB. Does anybody recollect who's a QIB? It's on the first chapter itself. What is the full form? For qualified institutional buyers. And we had seen mutual funds, CIS, anchor investors, foreign portfolio investors, etc., coming under this particular category. And if I only issue my securities to these selected individuals from the QIB group, then also it is called as a qualified institutional placement or QIP. In preferential issue and private placement, usually existing shareholders, a selected few are preferred. So let's say a company does a IPO, it issues shares to 1,000 shareholders. When it does rights issue, it has to issue the securities to all the 1,000 shareholders. When it does bonus issue also, it has to issue shares to all the 1,000 shareholders who will now become existing shareholders. In a private placement, preferential issue, the difference is all of them will not get the ability to access this new issue of securities. Only a selected few will be taken from this list and they will have an opportunity to participate in the issue. So these are the different types of issue. Already explained these before. Whenever you do any issue of securities, you have to file a prospectus. You use the word prospectus under Companies Act, but in this regulation, you use the word offer document. has the same meaning, but it is considered to be offer document. Prospectuses also are important to be remembered. So just like you have draft prospectus, you have draft offer document here, which always goes to SEBI first. SEBI is the watchdog, so you'll file all the draft versions of important documents first with them for approval. So just like under Companies Act, you have different types of prospectus. Here you have different types of offer documents. The draft offer document should be filed with SEBI at least 30 days prior to your offer document that is filed with ROC and stock exchange. So usually prospectus is equal to offer document. Draft goes to SEBI. Final goes to ROC and stock exchange along with SEBI. SEBI will check whether the changes that they have mentioned, that is implemented or not, and the time that SEBI usually takes to go through your draft prospectus is 21 days, and the gap between draft and final is 30 days. So SEBI, if it doesn't reply after 21 days, you can consider that your prospectus has been approved. Now, just like Companies Act, here also we have red herring prospectus or red herring offer document. Red herring is a type of a fish which is used as a bait to catch other fish. So just like small fish is used as bait to catch big fish, red herring fishes are typically used to catch other fishes. Why do we use this to call a prospectus by this name? So usually in most prospectus, price becomes a big point of debate. So usually price is decided by the company that is issuing the securities, and that is called as a fixed price issue. So all the issues that you're seeing, that is public issue. What are the other three apart from public issue? What are the other three called as? Anybody? Three, the traditional preferential issue. And what are the other two? You have private placement, and you have qualified institutional placement. And under public issue, you have IPO and FPO. For all these issues, company usually fixes the price per share because company only has to decide, right? But when company does not fix the shares, as a shareholder, would you invest in a company where you decide the price, or would you invest in a company where company decides the price? What is preferable to you if you had to invest your hard-earned money? What would you prefer? Yes, Malini, what do you think?
I would go with what the company has fixed price issue is good.
You trust companies so much in India? Do you think the companies would overcharge you or undercharge you? Usually. Will they charge you a premium or will they give you the shares at discount? Or will they issue at par? What do you think usually will happen? Will they give a 10 rupee share for 10 rupees? Yes, Manu?
So, the premium.
They'll charge premium, right? They can't issue a discount because... Why can't they issue a discount? Can anybody guess? you can only issue sweat equity shares. And sweat equity shares are only given to whom? Directors, employees, and promoters. As a public, are you a director of a company? No. Are you employee? No. Are you promoter? No. So they will not be able to give you discount. They don't want to give you par, so they will charge securities premium from you, and they will charge very high amount. And who decides how much premium is more feasible? Can you guess how much premium should be charged? Which intermediary will decide? Primary market or secondary market intermediary? What do you think? Rupees 10 is the face value. They want to charge 500 rupees securities premium. Issue prices 510. Who will make this decision? Primary or secondary market intermediary? Who will assist the company in deciding this? What are we doing in this chapter? We are doing issue of securities. Is this primary or secondary market?
Primary, sir.
This is primary market. And out of the primary market intermediaries, the merchant banker will play a very important role in helping you decide what should be the final price of your shares. So if company is gonna take the help of merchant banker, do you think they will charge a low price or will they charge high price from you? They will charge a very high price. So it's not good for you as an investor. So that is why when company does not fix the price, investors are attracted more. Why are they attracted more? Because who decides the price now? When company is not deciding the price, who gets to decide the final price? It is the public. So that gives the public an opportunity to decide how much will they be ready to pay for buying this share. And naturally, they'll be more attracted to investing in such company, just like the fish that I mentioned. Just like they are using the bait. And what is the bait here for red herring prospectus? Who fixes the price, company or public? Public fixes the price. Company does not. So that is the bait that is used to catch the fish. That is the investor. And that is why this prospectus is called as red herring prospectus. And the process by which they will issue these shares is called as book building process. That is herring prospectuses are issued. Now, whenever you issue these prospectus, you have to follow certain rules and regulations. If you're issuing a convertible security or an equity share, you have to follow this chapter, that is ICDR regulation, which is called issue of capital and disclosure requirement. That is the name of this chapter. So they had an advisory committee which was called as the Primary Market Advisory Committee. They come up with these regulations in the year 2018. So now IPO and FPO are the only options available. So all we need to know is what is the regulations that each of these issues require. So first let's understand IPO. In order to do IPO, you should not be debarred from accessing the securities market as a company or promoter. You should not be a promoter or director in any other company. So no common management. Then third, you should not be a willful defaulter. both your promoters or directors. Your promoters and directors should not be a fugitive economic offender, and you should not have any outstanding convertible equity shares or any other security in your hand, which means no outstanding convertible security. So if your company has issued any convertible debenture or any convertible preference share, first convert them properly into equity shares, and then you can raise more money from the public by issuing new equity shares. Remember, this chapter is only applicable for issue of equity shares and convertible securities. So basically, you should not be a scammer. No scam, no economic scam, no financial scam, no security market scam, and no common management. Plus, you should not have any outstanding securities. Then only your company can issue equity shares and convertible securities under this particular chapter. Different regulations will apply there. Now, who can issue equity shares and convertible securities under ICDR regulations? What is the full form of ICDR? Issue of
Capital and disclosure requirement.
which securities can you issue under this chapter? Can you issue a non-convertible debenture under this chapter? Convert. If you want to issue it, you should have net tangible assets of 3 crores or more. And if you have changed your name of your business in the last 1 year, 50% of this should be in monetary assets. You should also have an average operating profit of 15 crores or more in the last preceding 3 financial years on average. And you should have a net worth of at least 1 crores. What are the 3 requirements? Net tangible assets 3 crores, operating profit 15 crores, net worth 1 crore. Net worth is nothing but paid up capital and free reserves. If you have this satisfied these 3 conditions, you can do your IPO. You can get converted from an unlisted company into a listed company. Now, in addition to this, as I already said, you have to satisfy these 3 conditions. That is route number 1. Route number 2. Suppose you don't satisfy any of these conditions, then you have no choice but to do book building compulsorily. And whenever you do book building, which type of prospectus you have to issue? Special type of prospectus. Yes, Pooja. What is it called?
So red herring.
Red herring prospectus. So what are they trying to tell us indirectly? If your company is not a good or profitable company, if you're a good company, you'll have tangible assets, you have good profit, and you have good net worth. That means you're a good company, right? If you're a good company, you decide the price. Let the company decide the price. But if you don't satisfy any of these conditions, who is going to decide the price?
Public.
Public will decide the price. That's all. Very simple logic. Good companies only will be allowed to decide the price of their shares. Bad companies, yes, they might also need money to expand their business, even though they are struggling. But when they are struggling, they should not be given the power to decide their prices. So that is why you should do book building. For book building, you need to file which prospectus? Red herring prospectus. First, you file prospectus with SEBI. SEBI takes 21 days to provide comments, and you have to file final prospectus with ROC, Stock Exchange, and SEBI within 30 days of the draft prospectus. These are the only 2 options to do IPO in India. Either you become financially good and do your IPO, or even if you're financially bad, companies like Paytm, who didn't have a very financially successful model, they ended up doing option 2. Under option 2, 75% should be allotted to QIB. Who is QIB? Qualified institutional buyer. Yes, and when we are giving 75% of our shares to QIB, what will that issue be called? Indirectly, it will be called qualified institutional placement. Because you are not a financially strong company, you don't have net profit, you don't have net tangible assets, you don't have net worth, you have no choice but to take the help of QIBs. QIBs are people with lots of money, or they don't have money compared to us, compared to retail investors like you and me. Do they have more or less money?
More money.
Significantly more amount of money. Okay. So this is your eligibility criteria. Last 3 years. Do they satisfy net tangible assets? Yes. But 50% of the net tangible assets should be what assets? Monetary assets. Do you think this is 50% of this amount? Yes or no? Doesn't look like it, right?
Yes.
You have to have 50% of the net tangible assets as monetary assets, but it is only 4%, 8%, and 6%. Therefore, do they satisfy the condition or not?
No, sir.
So can they fix the price, or do they have to do book building and RHP? They have to do, this company has to do book building. This is the type of question you'll get in the exam. They'll just give you a balance sheet, check all the 3 parameters. Net tangible asset should be more than how many crores? 3 crores. So it satisfies that condition. Second condition, 50% of net tangible asset should be monetary asset. Does it satisfy that condition? No. Therefore, they cannot take route 1. They have to take route 2. And under route 2, they have to issue how many shares to QIP?
75%.
Okay. Extremely likely question in the exam. Second eligibility criteria, operating profit. How much operating profit should they have?
15 crores.
Do they satisfy this condition? Looks like they satisfy their conditions. What is the average? By the way, this is in lakhs. You guys are thinking this is in crores. This is in lakhs. 1630 lakhs is how many crores? 16.3 crores, 12.32 crores, and 18.6 crores, which gives you an average of 15.75 crores. So they satisfy, but they barely satisfy. So look into the amount column also. Don't just look into the numbers. Next, third criteria, net worth should be how much? 1 crore. Do you think these guys have 1 crore net worth? Look at the balance sheet. This is in lakhs. What is the value of net worth?
1 crore.
What is the formula for net worth? Paid up capital plus free reserves. What is paid up capital? Equity share capital is the paid up capital here. Reserves are 590. So your net worth is 2590 3430.47 and 4764. This is your net worth amount. Is it more than 1 crore? Definitely it is more than 1 crore. So you can go ahead. But since they don't satisfy this monetary assets criteria, they should or should not be allowed. That you have to check a little carefully. Okay, I told 50% is not minimum, 50% should be maximum. Just make a note of it. So net tangible assets is 3 crores. Maximum monetary assets should be 50%. Net worth is 1 crore and operating profit is 15 crore. This is the eligibility criteria. It is not minimum 50%, it is maximum 50%. Okay. If you adopt maximum 50% logic, can you issue or allow this company to do fixed price IPO, or should they do book building IPO? What will be your final answer now? Book building IPO. The final answer is they can go into route 1, because if you look at net worth, they have more than 1 crore. If you have operating profit, they have more than 15 crores. They have net tangible assets more than 3 crores on average, and their monetary asset is less than this 50% limit. Therefore, you can allow them to do fixed price. If they didn't satisfy this, then only you will ask them to do book building. Now you get into the process. First step is take in principle approval from the stock exchange. Get into agreements with primary market intermediaries. Just note down the keywords that I'm writing down. Take in principle approval from stock exchange. Enter into agreements with your primary market intermediaries. Ensure that you have made arrangements for 3/4 of the money that you are trying to raise from the issue, and make sure that you don't utilize the amount. The amount for general corporate purposes cannot be more than 25%. Company usually raises money for growth and expansion. That is when they do IPO or FPO or any other issue. But if you just want to pay off your existing loans, or if you want to raise money for paying salary to your employee, all such purposes are called as general corporate purposes. So whatever money you're raising, suppose you're raising 1,000 crores, you cannot use more than 25% of the amount raised for general corporate purposes. So you can only use 250 crores out of the 1,000 crores for general corporate purposes. And if you are trying to acquire another company, then the money that you use for general corporate purposes exclusively is max 25. But if you want to acquire a company and also use the money for general corporate purposes, then the limit is 35% of the amount that you're trying to raise. So if you raise 1,000 crores, and if you're trying to buy or acquire another company, you can use 350 crores out of that money for buying another company. So that is your IPO requirement. And then next is offer for sale. Offer for sale is slightly different from IPO. Here, promoters of the company sell their shares to the public. Whereas in an IPO or FPO, promoter does not sell their shares. Company issues new shares. So new shares are created in an IPO or FPO. But in an offer for sale, new shares are not created. Very important point to remember. LIC did this recently. LIC was a government company. They took some of the shares that the government held. The government wanted money for some infrastructure projects and other development work. So they sold a majority of stake in LIC to the public. So it was not a IPO, it was considered an OFS, or offer for sale. So in order to do an offer for sale, the shares should be fully paid up because you're not issuing new shares, you're just selling your existing shares. The shares should be held by the promoter or sellers for at least 1 year. And just like IPO, you should also file a draft offer document and final offer document. Draft offer document, who do you file with? Do you recollect? Final, you file with SEBI, ROC, and Stock Exchange. But draft offer document, who do you file?
SEBI.
Only SEBI. And what is the gap? 30 days. Same thing applies. SEBI has 21 days to publish its comments. So that is an offer for sale. Those are the only conditions. Make sure that if you're doing an offer for sale, they are selling. There has to be a ratio that you have to follow. Any offer for sale in which the pre-issue shareholding. There are two types of shareholding, pre-issue and post-issue. So let's say company is selling 1,000 crores worth of their shares. This 1,000 crores cannot be more than 50% of the total share capital of the company. Okay. So if a company has 2,000 crores worth of equity shares, and let's say promoters have 1,500 crores worth of equity shares with them, they can only sell up to 1,000 crores worth of their equity shares maximum in this offer for sale. They cannot sell their entire 1,500 crores. After selling their 1,000 crore shares, how much shares do they have now? They are left with 500 crore shares with promoters, right? And what is the total share capital of this company? 2,000 crores still. How much is the promoter shareholding now? It is 25%, which is more than 20%. Whatever is remaining after the offer for sale completes should be still more than 20%. That is how you should read this particular regulation. Clear? If you're a promoter or any other person who holds significant shares, this is the rule. If you're not a promoter or if you don't hold significant shares, that 50-20 becomes 20-10. You can offer 20% of your pre-issue share capital, and post-issue at least 10% you should hold in the company. And if you are holding significant shares, you can maximum sell 50% of your shares, and after selling 50% of your shares, make sure that your remaining shareholding is at least 20% in the company. That is a rule for offer for sale. So first we saw public issue, then we saw offer for sale. Now you are seeing warrants. This is one of the last types. Warrants are converted into equity shares. So that is why we are seeing this under ICDR regulations. Warrants can also be issued in the same way, just like equity shares. Now that was IPO. Now we go into FPO. FPO means further public offer. This is after IPO. So make sure that the same 5 conditions that we saw before. No economic scam, no financial scam, no capital market scam should have been committed by the promoter group. And for doing FPO, the only condition is if you have changed your name in the last 1 year, at least 50% of your revenue in the last 1 year should be from the new name. Suppose Infosys becomes Infosys Cakes and they start selling cakes. And after they start selling cakes, obviously they need more money to expand their business. The money earned from cakes should be at least 50% of the total revenue of the company. Then only Infosys can raise money from the public. So Infosys stops doing IT business and gets into cake business. This is the rule for that entity. And you can only do book building offer here if you don't satisfy the above condition. If you get this much revenue, then who decides the price? Company will decide the price. It will become fixed price. If you don't satisfy this only condition, then what issue will you do? Book building. In book building, who decides the price? Public decides the price. Alright, so always they will give you two options. Option one, if you satisfy the criteria. Option two, if you don't satisfy the criteria. The conditions apart from this are all the shares should be fully paid. All the shares should be dematted or dematerialized, no physical shares. All the previous shares should be listed in the stock exchange. And you should at least have 75% firm arrangements, which was the same rule as before. Whatever amount of money that you're trying to get funding from the public, make sure that you are making arrangements for using 75% of the same for a particular project. So basically, if you try to raise 1,000 crores, how much should Infosys Cake use for cake manufacturing? It should use at least 75%. That is called firm arrangement. Rest maximum 25% it can use for what purpose? General corporate purpose. If you remember, there are three rules. Whatever money you raise, whether it is IPO or FPO, you have to utilize it. 75% should be used for firm arrangements, that is for company projects, expansion projects, etc. 25% can be used for general corporate purpose. But if you're trying to buy a company, you can use 35%. So that time you have to make firm arrangements only for 65%. So firm arrangement becomes 65. 35% can be for general corporate purpose plus buying another company, acquisition of other company. So this is the breakup of the money that you raise from any IP. Whatever money that you are raising 1,000 crores. Promoter should put 20% of that personal. That is called promoter's contribution. So if you're trying to raise 1,000 crores, 20% comes from promoter, and this promoter's contribution is locked in for 3 years. That's also an important point to remember. If you are doing ICDR regulation, this rule applies. If you are doing any other debt or any other type of issue of other security, then this rule does not apply. So lock-in requirements, promoter's contribution 3 years, that 20%. Sometimes if company is trying to raise 1,000 crores, promoter is giving 300 crores. Promoter contributes 300. So that makes a total of 1,300 crores, let's say. You raise 1,000, promoter puts 300. This is more than the 20% required. Therefore, what you can portion, that is 200 crores, will be locked in for 3 years. That extra 100 crores that promoter gave, that will be locked in only for 1 year. Typically. And if you're issuing any SR equity shares, which are special types of equity shares having similar features as a DVR, then locked in would be same as the original equity share. Suppose you're issuing DVR or any other special right holding equity shares. So that's promoter's contribution. Apart from this, appoint all the primary market intermediaries who are the 5 PMIs, merchant banker, appoint RTA, appoint underwriter, appoint bank, and if you're issuing debentures, appoint debenture trustee. Have separate contracts with all 5 of them, have separate transactions and unique appointments for all 5 of them, and each 5 of them have their own responsibility, which we have seen in the capital market intermediary chapter. So to ensure all these obligations, make sure that you appoint a compliance officer also. First goes to SEBI, 21 days, then final prospectus within a gap of 30 days from the original, and make sure that whatever type of prospectus that you are issuing, you see which issue you are doing and do the relevant prospectus. If you are deciding the price as company, you issue normal prospectus, which is called as offer document. If you are not issuing or deciding the price, then you have to issue red herring prospectus. Apart from that, you have to go for ASBA, that is application supported by blocked amount. You have to block the bank account of all the people who apply for buying your shares. You have to get your IPO graded from a credit rating agency who are a different type of intermediary we saw earlier. You have to appoint underwriter. You have to make advertisements before opening the IPO, and you have to appoint a monitoring agency if you are trying to raise more than 1,000 crores. So since we are raising 1,000 crores here, if you are raising more than 100 crores, you'll have to appoint a monitoring agency. This entire process, end to end, should be finishing in 12 months. Minimum subscription is 90% because we are issuing equity shares, and equity shares minimum subscription is 90. Debentures minimum subscription is 75. We already know this. Make sure that once you open the IPO, it is open for 3 to at least 10 days. And if you are charging 100 rupees per share, minimum amount that you have to take from share application is 25%. If you remember all these points, you should be good to go for this particular chapter. Okay. So this is a major chunk of this particular chapter. Make sure that you remember this. Rest of the chapter we will continue on Thursday. Okay, this is the portion we will do in the next chapter along with a few miscellaneous topics from this chapter.